Welcome back to the Ultimate Trading Podcast for beginner traders. You're listening to the Fundamental Analysis chapter, where we're exploring tips 21 through 30, and today we're diving deep into tip 28, economic calendars. Now, if you've ever felt blindsided by sudden market moves or wondered why prices swing sharply after certain announcements, you're about to discover a tool that can give you a strategic edge, something that separates reactive traders from those who act with foresight and precision. At its core, an economic calendar is exactly what it sounds like, a schedule of key economic events that could move the markets. Think of it as your trading GPS. It tells you when to expect turbulence, where the opportunities might appear, and when it's best to stay cautious. This includes major economic data releases like GDP reports, employment figures, inflation statistics, and central bank meetings. Each of these events carries the potential to reshape investor sentiment almost instantly. Nobel laureate Paul Krugman puts it well: the reaction of markets to economic announcements is often sharp and sudden, making awareness of timing essential for traders. Let's break it down further. Why are economic calendars so important? First, they help you understand market influences. Market psychology is often shaped by expectations surrounding economic data. Robert Shiller, another brilliant economist, noted that market psychology is often shaped by expectations around these data points, affecting everything from stock prices to bond yields. A better-than-expected jobs report can boost confidence and send equity markets higher, while an unexpected interest rate hike can trigger sudden selling across multiple asset classes. By tracking these events, you're not guessing, you're anticipating. Economic calendars also allow you to prepare for volatility. Anyone who's traded during a non-farm payroll announcement or a central bank rate decision knows the price swings can be dramatic. The volatility is not random, it's event-driven. If you're aware of the timing, you can adjust your positions, tighten your stop losses, or even step aside until the dust settles. This is what separates disciplined traders from those who get whipsawed by market noise. Using an economic calendar effectively requires understanding its key components. Each entry typically includes a brief description of the event, like ECB interest rate decision or non-farm payrolls. You'll also see the date and time, often with time zones specified, which is critical if you trade across international markets. The country is indicated, providing context on which markets might react. Many calendars include an impact indicator, showing whether an event is expected to have high, medium, or low significance. Finally, they often display previous and forecasted data, which gives you a benchmark to measure the actual release against. Interpreting economic data goes beyond just reading the numbers. Traders must consider actual versus forecasted figures, analyzing whether the market is likely to react positively or negatively. Trends over time are also important. Consistently improving data may indicate a strong economy, whereas declining trends could suggest trouble ahead. And, crucially, always consider context. An interest rate hike can be bullish if it reflects a robust economy, or bearish if it sparks concerns about inflation or liquidity. To bring this to life, let's look at a real-world case study: the 2018 U.S. tax reform. In late 2017, the Tax Cuts and Jobs Act of 2017 was proposed, creating significant market anticipation. An economic calendar during this period would have been packed with key dates: the initial proposal announcement in September, congressional votes in the House and Senate, and finally, the president's signing of the bill into law in December. Traders who tracked these events were able to anticipate market reactions rather than react blindly. As the legislation progressed, equity markets rallied on the prospect of corporate tax cuts, with major indices like the S&P 500 and Dow Jones Industrial Average climbing steadily. Currency markets also fluctuated, as the US dollar strengthened in anticipation of potential economic growth and capital inflows. Bond markets experienced volatility, reflecting concerns about rising deficits and expected government borrowing. By monitoring these events on an economic calendar, traders could strategically position themselves, whether it was entering long positions in equities or adjusting currency exposures in anticipation of dollar strength. This example demonstrates three key lessons. First, anticipating market moves is possible if you know what's coming. Second, you can manage volatility by avoiding large positions before major announcements, reducing the risk of sudden losses. Third, economic calendars enable strategic positioning, helping traders make informed decisions that take advantage of market reactions rather than being caught off guard. So, how do you make this practical in your daily trading routine? Start by customizing your calendar. Focus on the countries, events, and impact levels that matter most to your strategy. Set up alerts and notifications so you're never blindsided by a key release. And take the time to review past events, noting how markets responded to different types of economic data. This historical perspective helps refine your strategy and gives you a predictive edge over traders who ignore these insights. Let me leave you with a question to think about. Reflect on a time when an economic release surprised you and caused unexpected market moves. Could tracking that event in an economic calendar have changed your trading decision? Share your experiences in the comments. I'd love to see how you navigated these moments and discuss strategies that could help others. In conclusion, economic calendars are far more than a schedule. They are a strategic tool that allows traders to anticipate volatility, plan entries and exits, and capitalize on opportunities in a disciplined, informed manner. As John Maynard Keynes once said, markets can remain irrational longer than you can remain solvent, emphasizing the importance of preparation and foresight. Incorporating an economic calendar into your trading routine isn't just recommended, it's essential for navigating the fast-paced, event-driven world of financial markets. That wraps up Tip 28, Economic Calendars. Stay disciplined, stay informed, and remember, trading isn't about luck, it's about preparation, strategy, and timing.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading.